Personal finance segment, and yesterday we were discussing debt funds
Yes.
and how handsomely they've rewarded investors.
They have rewarded investors well. In fact, since yesterday it's gone up a few, percent points as well. So debt funds are doing well, and for a lot of our viewers who possibly will be looking at making a more conservative stance, FMPs being out after the change in the budget, we'll find out if they should be using long-term, GSEC bonds at this point, or funds that invest in GSECs, to see if they can take advantage of a possible interest rate cut going forward into early next year. Let's bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, we were talking yesterday about the medium and long-term gilt funds that have given about 6.5% right now over the last 6 months. Income funds at 5.6% today. What's causing the turnaround?
The cause, I would attribute this turnaround. I would not say that this is a big turnaround. This is a kind of return which is 20% more than what you will earn on a one-year term deposit. So in that sense, it is not a huge return. But certainly, it's a decent return. And I would attribute this return enhancement, or, a little improved return, to primary thinking that interest rates are unlikely to go up. So once the RBI governor has stated that interest rates will not go down, and they may not go down in a hurry, but the very comfort that investors derive, or the fixed income investors, the people who buy bonds, so in that sense, that has been the primary cause. But at the same time, I would say that don't get impressed by these numbers. Debt funds, because they are rooted in reality, fixed income funds, they invest in bonds. The attributes of a bond are very well clearly laid out. You very well know what is the quality of the bond. It is also quantified, somewhat quantified in the form of a rating. You also know the tenure, and you know the coupon. So bonds cannot really behave like equity, and bonds cannot really crumble like equity sometimes. So in that sense, bonds do work in a certain range, and that provides it the range which one can say that you have greater predictability. And whatever happened in the last 2 years, a year and a half back, that was very disappointing. And that is something which can't be ruled out, because I don't think the world has changed from the dynamics has changed. So nasty surprises coming, and you can't rule that out. So investors should be wary of trying to benefit from the enhanced return of fixed income funds.
Dhirendra, what's your prediction of debt fund returns over the rest of the financial year going into early next year's calendar? What do you think the pattern is going to be from these funds?
No, I'll be very pleased. I would not say that I can predict it, but I'll be very happy, and I expect that the kind of return generated in the last 6 years last 6 months should be repeated. And I do not anticipate a big, surprise coming our way. On the contrary, there is a great positive that can happen. That inflation, the way it's looking like, we are likely to see moderation of inflation. That might trigger a rate cut, and it may happen earlier than anticipated, going by the early symptoms that we see. But at the same time, we should not forget that foreigners have become, FIIs have become a very dominant player in our fixed income market. They find it attractive, they find the yields attractive, and their world can change. Last time we saw the big surprise, the big event that happened was not that there was any calamity, just that fixed income investors, foreign fixed income investors in India, they were pulling their money out for their own reason, and that caused a panic in the market. So that is something which is a big negative, because the role of FIIs in our bond market, and we don't have that experience. FIIs were never a big force in the bond market. Now they are, and because they work in a very defined range, so that is a risk that has been added to the fixed income market. At the same time, there is a positive. So I would say that investors should be wary of, should try and balance these two things.